This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to TF Metals Report podcast highlights for the week of December 6th, 2021. We knew it was going to be a mostly quiet week leading up to the biggest data point of the week, which would come on Friday, the latest update on U.S. inflation. But even though it was kind of a quiet week, we weren't short of things to discuss. Remember, every single day you get a podcast summary of the day's events as a member of TF Metals Report. Just all part of the value of having a subscription at my site. So back on Monday, one of the things we discussed was the latest trend of deliveries for COMEX gold for the month of December, about the biggest delivery month of the year. And we caught something, of course, the CFTC doesn't seem to give a darn about, but we always sure seem to notice. That's when one of the bullion banks is in excess of the stated position limits. You're not supposed to go over 6,000 contracts in the front or delivery month, but here's Bank of America, which is basically Merrill Lynch, already delivering 11,000 contracts, all while the CFTC snoozes and looks the other way. That was a topic of discussion on Monday, December 6th. Deliveries are underway in COMEX gold. Somebody asked late last week if I'd noticed Bank of America securities and their house account in this month's delivery notices. And so I'll bring that to your attention, even though it's, again, we know it's utterly meaningless. The CFTC doesn't care. Bank of America securities, of course, that is another name for Merrill Lynch. If you go back in the day, okay, I'm talking like a decade ago, pre-financial crisis, Merrill Lynch used to be kind of in that bullion banking group with Citi and Morgan Stanley and JP Morgan, and Bear Stearns and all those, maybe not so much, who knows, back in the day, okay? Merrill Lynch then, of course, at the great financial crisis, teetering on the brink of collapse, was merged into Bank of America. And so when you see Bank of America securities on your delivery notices, think of that as the old Merrill Lynch trading desk, whatever. Okay, this is a snapshot from Friday night's delivery notices, okay? You can see so far this year, you've got, just like JP Morgan, a customer account of Bank of America and a house account. Now, what do we have here? Well, customer account doesn't really do much. Pretty light. Occasional issuances, occasional stoppages, but very small numbers. Rarely more than 100 for a month. The house account, the proprietary account, some bigger numbers, okay? But nothing like JP Morgan style, right? Until now. So suddenly here in December, the house account of Bank of America has delivered 11,701 gold contracts. Couple things come to mind. So did the Bank of America house account, were they the ones that were at least one of the parties that was actively capping gold on the way up, issuing contracts, and now they're having to deliver out, whatever they're delivering out? Okay, that's something to ponder. What else is going on here? What's the front month position limit? What is that number? It used to be 3,000 contracts. Then after the debacle of March 2020, it's now 6,000 contracts. And what is the house account of Bank of America? That should be just one entity. That's a proprietary account. 11,701, more than double the stated front and delivery month position limit. Think anybody cares? No, of course not. Anytime I've ever complained, and to the point where I gave up complaining, writing, leaving voicemails for the CFTC, the one time they ever bothered to get back to me, they said, well, there are bona fide hedging exemptions, and I'm sure in this case, I was complaining about JP Morgan and silver. They have bona fide hedging exemptions, and in this case, I'm sure that's what it is. If you have any other questions, feel free to give us a call. Okie dokie. So there you go. JP Morgan, Bank of America, 11,701 December gold deliveries and counting. How about that? On Tuesday, December the 7th, one of the charts we reviewed was the daily chart of gold. We do that almost every single day, a lot of times looking at moving averages, other technical indicators. On Tuesday, though, we took a look at just the stratified nature of the chart. Seems to be that gold, at least for the last 6 months, moves within $40 ranges. Up 40, down 40, in a range, whether it's 1720 to 1760 or 1800 to 1840. For some reason, there are these $40 ranges in the price of gold. You can see it for yourself on the chart here. And that was a topic of discussion back on Tuesday. What I think is interesting is when patterns like this develop. And you can see this on the chart. Now again, maybe I'm just a lunatic who stares at charts all day and spends too much time in front of a screen and too much time by himself, and I'm just John Nash in his garage connecting strings to stories all over the wall in my head. But I always find this stuff fascinating. You can clearly see on this chart of February gold going back to the 1st of June, basically, including the plunge that took place on June the 16th when the Fed announced that interest on excess reserves and all of a sudden the dollar started moving higher. We go back since then. Notice these levels that are $40 apart. Isn't that interesting? You got support at 1760. You've got support at 1720. You've got resistance at 1840. And again, last couple weeks ago at 1880. And then right down the middle at 1800 is this kind of oscillation line. Psychological resistance, whatever you want to call it. It acts as either support or resistance, depending on which side you're on. If you're coming up from the bottom, it's resistance. If you're above it, it offers support. You can clearly see that. I'm not saying things. And you can clearly see the other $40 intervals. If you're below 1800, you got support at 1860. You're above 1800, you got resistance at 1840. I just think this stuff is fascinating. In terms of technical analysis, it's always been my view that the longer-term chart is going to be the most helpful. If you look at the hourly chart, maybe that helps you day to day. The daily chart kind of helps you spot short-term trends. The weekly chart may be more intermediate trends. But the longer-term secular bull and bear market trends are visible on the monthly and even the quarterly charts. So one of the things we took a look at on Wednesday, December 8th was the monthly chart of COMEX Gold going all the way back to 1980. You can see some long-term patterns here that look vaguely familiar. And that has implication for 2022 and beyond. But when we're talking a 40-year chart of COMEX Gold, as you see here, the monthly chart, these are significant technical formations, okay? Going back to 1980 with that peak that got all the way up to 875. You can see through the course of 1980 and into New Year's 1981, about something around 700 was resistance. Then you went into this long, 26, 27 year? Seriously? Yes. Where it went nowhere. Up, down, but really nowhere. Massive cup, if you will. And then, many of you will recall, in late 2007 and early 2008, price broke above, went to new all-time highs, briefly getting to $1,000 in March of 2008, and then pulling back with the financial crisis in a perfect cup handle. And then a move from 700 to 1900. That's a move of more than 150% in a couple of years. So what do we have now? Again, on the same long-term chart, another cup and handle. Chris ran several different technical forecasts off of this chart, and a couple of them came up with the exact same projection of $2,700 by late next year, maybe 2023. Hey, that'd be perfectly fine with me. But like I said, coming out of the handle in 2009, we rallied 150%. Well, 150% on 1,800 would give you something more like what, 4,500? I'm not going to go there. That just sounds like that's crazy talk, wishful thinking, sunshine pumping. But what I can tell you is you look at this chart, you see 40 years worth of monthly candles. I mean, these are some significant long-term trends. And so when you view this year's consolidation and flag in a 40-year or through a 40-year lens, it begins to look like that period in 2008. I mean, that was, there's 20 years and it went up and down and did nothing, basically nothing for a year. It was back at 700 before it exploded. Are we about ready to explode again? This week's Thursday Conversation, which is always a free podcast. You can stop by TF Metals Report anytime, whether you're a member or not. You can listen to Thursday Conversation for free and pass along a link if you find it interesting. And our conversation this week was with the legendary James Turk, who, of course, founded Gold Money a few decades ago and is a gold expert like no one else. He follows the physical market, the London markets, the paper markets, and he's also an author. So James stopped by on Thursday, December 9th to talk about his new book, Money and Liberty, something you might want to check out on Amazon, maybe give away as a great gift idea, but also full of other fantastic insights. So make sure you stop by TFMR, click the link, Thursday Conversation with James Turk. I'm sure you'll find it fascinating. And on Friday, December 10th, the latest update on U.S. consumer price inflation was released. And man, it was another doozy. Up 0.8% for just the last month. If you annualize that, you're at 10%. And if you annualize the last 12 months, we're now up at 6.8%. That's the highest CPI in the U.S. in 40 years, going back to 1982. You wouldn't know it by looking at the precious metals, of course. They barely recovered from their earlier lows this morning, and silver now actually finally up, but has been down 15 of the last 18 days. The only good thing we can say about silver is it recovered and finished the week above 22. That is a key level. Can dip down there on a daily basis, as it has now a couple of times, but it needs to remain above there on a weekly closing basis, as you can see on this weekly chart. The breakout holds, the consolidation pattern holds, as long as the weekly close remains above 22, and at least accomplish that here on Friday. Now, next week's another story. We can't take the rest of the year off just yet. The December FOMC meeting is Tuesday and Wednesday of next week. That's when we will get Powell and his press conference, any update on taper, any rate hike plans, all of that stuff will be Wednesday of next week. So make sure you're paying attention. Don't call it a year just yet. And then come back next Friday for another one of these TF Metals Report podcast highlights. Thanks for listening.